I'm John A.G., and this is the Collapse Files. Between November 12th and December 12th, 2025, approximately $2.3 trillion in market capitalization disappeared from global risk assets. U.S. equity markets declined $1.4 trillion. European equities fell $380 billion. Emerging market stocks lost $290 billion. High-yield corporate bonds declined $180 billion. Cryptocurrency markets contracted $110 billion. The combined loss represents 4.1% of global risk asset valuations in 30 days, the fastest monthly decline outside of recession or crisis periods since March 2020. The official narrative frames this as a normal correction after an extended rally. Markets were overbought. Profit-taking was inevitable. Valuations were stretched. This is presented as routine market mechanics. Nothing systemic, nothing structural, merely a healthy pause in an ongoing bull market. The S&P 500 declined 8.4% from its November peak, but remains 11% above its January 2025 level. Corporate earnings are projected to grow 8% in 2026. Unemployment stands at 3.9%. There is no recession. The decline is framed as opportunity. But the composition of the flows reveals a different pattern. The $2.3 trillion did not rotate into other risk assets. It did not move from equities to corporate bonds or from U.S.-owned stocks to emerging markets. It moved into cash equivalents and short-term government securities. Money market fund assets increased $340 billion during the same 30-day period, the largest monthly inflow in 18 months. Two-year Treasury yields fell from 4.38% to 4.21% as demand surged for short-duration safe assets. The VIX Volatility Index spiked from 13 to 27 before settling at 21, indicating elevated fear despite market stabilization. When $2.3 trillion exits risk assets in 30 days and flows into cash rather than rotating within risk markets, it signals not profit-taking, but fear-driven deleveraging. What triggered the largest monthly capital flight from risk assets in nearly 5 years during a period when economic data shows no recession and corporate earnings remain positive? The decline began on November 12, 2025, when the October Consumer Price Index was released showing inflation at 3.2% year over year, unchanged from September despite expectations of moderation to 3.0%. More concerning was the core CPI, which rose 0.4% month over month, the largest monthly increase in 6 months. The immediate market response was muted. The S&P 500 fell 1.1% on the day. But the decline did not stop. Over the following 22 trading days through December 12th, the index fell an additional 7.3%, compounding to the 8.4% total decline. The speed of the move was abnormal. 8% declines occur periodically. Markets experienced similar corrections in February 2024, October 2023, and March 2023, but those corrections unfolded over 6 to 8 weeks. The current decline compressed into 22 trading days, representing a velocity of decline 2.5 times faster than typical corrections. Velocity matters because it indicates urgency, participants exiting positions rapidly rather than gradually reducing exposure over time. Volume patterns confirmed forced selling rather than orderly profit-taking. Average daily trading volume in S&P 500 stocks during the decline period was 14.2 billion shares, 38% above the 6-month average of 10.3 billion shares. High volume during declines indicates selling pressure, forcing liquidation at prevailing prices rather than patient sellers waiting for favorable levels. Additionally, the breadth of the decline was severe. On the worst single day, November 26th, over 92% of S&P 500 constituents declined, indicating systematic selling across all sectors rather than sector rotation. The magnitude was concentrated in specific categories that reveal the underlying dynamic. Technology stocks, which had led markets higher throughout 2024 and early 2025, declined 11.3% during the 30-day period. The Nasdaq 100 fell 10.8%. Small-cap stocks, represented by the Russell 2000, fell 9.7%. High-yield corporate bond spreads widened from 315 basis points over Treasuries to 428 basis points, a 113 basis point widening in 1 month, representing the sharpest credit spread expansion since March 2023 regional banking stress. International markets showed similar patterns indicating global rather than U.S.-specific dynamics. The MSCI Europe Index fell 7.2%, and the MSCI Emerging Markets Index declined 8.9%. Japan's Nikkei 225 fell 9.1%. China's CSI 300 fell 6.4% despite government stimulus announcements. The synchronized global decline suggests a shared driver, likely rising real interest rates affecting all risk assets simultaneously rather than country-specific concerns. The flow into cash equivalents was dramatic and specific. Money market fund assets increased from $6.08 trillion on November 12th to $6.42 trillion on December 12th, a $340 billion inflow. This represents a 5.6% increase in 1 month. The composition shows preference for safety over yield. Government-only money market funds received $280 billion of the inflow, while prime funds received only $60 billion. Investors were prioritizing Treasury backing over higher yields available in commercial paper or corporate debt. Treasury market behavior confirmed flight to safety dynamics. The 10-year Treasury yield fell from 4.45% to 4.18% during the period, despite no change in Federal Reserve policy. Yields fall when prices rise from increased demand. The demand was concentrated in shorter maturities. The 2-year yield fell from 4.38% to 4.21%, a 17 basis point decline, while the 10-year fell 27 basis points. This curve steepening typically occurs when markets expect near-term economic weakness. Corporate credit markets showed stress beyond just spread widening. Investment-grade corporate bond issuance during the 30-day period totaled only $78 billion compared to typical monthly issuance of $120 to $140 billion. High-yield issuance was $12 billion versus typical $25 to $30 billion. Reduced issuance during market stress indicates either borrowers pulling deals due to unfavorable pricing or underwriters unable to place bonds with investors. Either interpretation suggests credit market dysfunction beyond normal volatility. The cryptocurrency market decline added $110 billion to the total outflow from risk assets. Bitcoin fell from $91,500 to $76,800, a 16% decline. Ethereum fell 22%. The magnitude exceeds traditional risk assets, consistent with crypto's higher beta to risk sentiment. But the timing, declining simultaneously with stocks and credit, indicates crypto is functioning as a risk asset rather than an uncorrelated alternative, contrary to narratives positioning it as digital gold or inflation hedge. Modern financial markets function as a liquidity circulation system, where money flows continuously between cash, bonds, stocks, and alternative assets based on expected returns and perceived risks. The system operates smoothly when participants can freely allocate capital, when buyers and sellers can transact at predictable spreads, and when leverage amplifies returns without creating systemic fragility. The core mechanism is the risk-free rate, serving as the baseline for all asset pricing. Currently, the risk-free rate is represented by short-term Treasury bills yielding approximately 4.2%. Every other asset must offer a premium above this rate to justify the additional risk. Stocks must offer expected returns above 4.2% to compensate for equity risk. Corporate bonds must yield more than 4.2% to compensate for credit risk. Real estate must generate cash flows exceeding 4.2% to justify illiquidity and management costs. When risk-free rates rise, the required premium for all riskier assets must increase proportionally. If Treasury bills yield 1%, investors might accept 7% expected returns on stocks, a 6% equity risk premium. If Treasury bills yield 4.2%, investors require 10-11% expected returns on stocks to maintain the same 6% premium. This means either stock prices must fall to create higher expected future returns from current levels, or corporate earnings must accelerate to justify current prices at higher discount rates. The system has functioned for over a decade with risk-free rates near zero. From 2009 through 2021, Treasury bills yielded 0 to 0.25%. This created a structural incentive to own any asset offering positive returns. Stocks yielding 2% dividends were attractive when cash yielded 0. Corporate bonds yielding 3% were compelling when Treasuries yielded 1%. Real estate generating 4% cash yields justified high valuations when alternative yields were negligible. The zero-rate environment funneled capital into risk assets because there was no alternative. The Federal Reserve's rate hiking cycle from March 2022 through July 2023 raised the federal funds rate from 0 to 5.25%. But the full impact was delayed because inflation remained elevated. When Treasury bills yield 4.2%, but inflation runs at 4%, the real yield, the return after adjusting for purchasing power loss, is only 0.2%. Investors could justify holding risk assets because cash provided minimal real return despite higher nominal yields. The critical shift occurred in late 2024 and intensified in November 2025. Inflation moderated from 4.0% to 3.2%, while Treasury bill yields remained near 4.2%. This created a real yield of approximately 1.0%, positive real returns on cash for the first time since 2019. Simultaneously, the Federal Reserve signaled it would maintain rates elevated for longer than markets expected, reducing the probability of near-term cuts that would restore lower risk-free rates. Positive real yields on cash fundamentally alter the incentive structure. When cash provides 1% real return with zero volatility and full liquidity, the required premium for risk assets increases substantially. Stocks must now offer 11 to 12% expected returns rather than 9 to 10% to justify equity risk. Corporate bonds must yield 6 to 7% rather than 4 to 5% to compensate for credit risk. At current earnings and bond coupons, achieving these higher expected returns requires lower prices. The adjustment mechanism is forced selling, creating price declines that raise forward expected returns. If a stock trades at $100 and generates $5 in annual earnings, the earnings yield is 5%. If markets require 11% expected return, the price must fall to approximately $45 to create an 11% earnings yield. The adjustment occurs through selling pressure, driving prices lower until expected returns reach required levels. Leverage amplifies this dynamic. Many market participants, hedge funds, proprietary trading firms, private equity, operate with leverage ratios of 2.1 to 5.1. When prices decline and margin requirements increase, leveraged investors must either post additional capital or reduce positions. Most cannot post additional capital on short notice, forcing position reduction through selling. This selling creates further price declines, triggering more margin calls, creating a self-reinforcing deleveraging spiral. The flow into money market funds and short-term treasuries indicates participants are choosing positive real yields with zero risk over uncertain returns from risk assets. This is rational when cash provides 1% real return and stocks face declining earnings, tightening credit conditions, and elevated valuations. But the aggregate effect is capital withdrawal from the system that finances corporate investment, supports equity valuations, and provides credit to businesses and consumers. The system is failing at the transmission mechanism level. Central banks raised rates to cool inflation by making borrowing expensive and saving attractive. This is working. Capital is flowing into safe assets, offering positive real returns. But the second order effect is that risk assets are being drained of capital, creating price declines that threaten wealth effects, corporate funding, and financial stability. The Fed cannot easily reverse course because inflation remains above target, but allowing the drain to continue risks market dysfunction and potentially recession as falling asset prices reduce consumption and investment. The numerical evidence reveals not just a decline, but a systematic repricing across all risk asset categories, reflecting higher real interest rates and tighter liquidity conditions. Equity market declines were concentrated in the highest valuation segments. The S&P 500 price-to-earnings ratio fell from 21.3 on November 12th to 19.4 on December 12th, a 9% compression. But the NASDAQ 100 PE ratio fell from 28.7 to 25.1, a 12.5% compression. Technology stocks with PE ratios above 30 declined an average of 13.8% during the period, while stocks with PE ratios below 15 declined only 4.2%. This valuation-based dispersion indicates markets are repricing growth stocks more aggressively as higher discount rates reduce present value of distant future earnings. The bond market repricing was equally severe. Investment-grade corporate bond spreads widened from 112 basis points over Treasuries on November 12th to 156 basis points on December 12th, a 44 basis point widening in 1 month. High-yield spreads widened from 315 basis points to 428 basis points, a 113 basis point move. The magnitude of spread widening equals or exceeds moves seen during prior credit stress events. During the 2023 regional banking crisis, high-yield spreads widened 97 basis points. The current 113 basis point widening is more severe, despite no visible bank failures or credit events. Credit market stress is visible in issuance collapse. Investment-grade corporate bond issuance totaled $78 billion in the 30-day period versus $135 billion in October and $128 billion in September. High-yield issuance was $12 billion versus $28 billion in October. The decline represents a 42% reduction in investment-grade volume and 57% reduction in high-yield volume month over month. Companies are either choosing not to issue at current spreads or finding insufficient investor demand to complete deals. Money market fund flows show clear preference for safety. Government-only money market funds received $280 billion in inflows during the 30 days, bringing total assets to $4.82 trillion. Prime institutional money market funds received only $42 billion, bringing assets to $1.21 trillion. Retail money market funds received $18 billion. The concentration in government-only funds, 82% of total inflows, indicates investors are prioritizing Treasury backing over the modestly higher yields available in prime funds that hold commercial paper and corporate debt. Treasury yield curve behavior reflects flight to safety and recession concerns. The 2-year Treasury yield fell from 4.38% to 4.21%, while the 10-year fell from 4.45% to 4.18%. This created curve steepening from 7 basis points to negative 3 basis points, a 10 basis point shift toward inversion. Yield curve inversion, where short-term yields exceed long-term yields, has preceded every recession in the past 50 years. The move toward inversion during a period of risk asset selling suggests markets are pricing increasing recession probability. Real interest rates, calculated from inflation-protected securities, provide direct measurement of the real yield shift. The 10-year Treasury inflation-protected security, TIPS, yield rose from 1.82% on November 12th to 2.08% on December 12th, a 26 basis point increase. This 2.08% real yield is the highest since November 2023 and compares to negative real yields throughout most of 2021 and 2022. Positive and rising real yields make holding cash and short-term bonds more attractive relative to risk assets. The break-even inflation rate, the difference between nominal Treasury yields and TIPS yields, declined from 2.63% to 2.10%, a 53 basis point decline. Break-even inflation represents the market's expected average inflation over the bond's life. The decline from 2.63% to 2.10% indicates markets expect inflation to moderate below the Fed's 2% target, potentially signaling deflationary pressures if economic activity slows substantially. Corporate earnings revisions show deterioration matching price declines. Analyst consensus earnings estimates for S&P 500 companies in 2026 were revised down from $250 per share on November 12th to $246 per share on December 12th, a 2.4% reduction in 1 month. The ratio of downward earnings revisions to upward revisions reached 2.31, meaning for every company seeing earnings estimates raised, 2.3 companies saw estimates lowered. This negative revision ratio typically occurs during recessions or earnings recessions, not during periods of 2.5% GDP growth and sub 4% unemployment. Margin debt, the amount investors borrow to purchase stocks, declined from $731 billion on October 31st to $693 billion on November 30th. A $38 billion or 5.2% decline in 1 month. Margin debt declines indicate deleveraging as investors either voluntarily reduce borrowed positions or are forced to sell due to margin calls when collateral values decline. Put call ratios spiked during the decline period, reaching 1.18 on November 26th, the highest reading since March 2023. Put call ratios above 1.0 indicate more put options, bets on declines, are being purchased than call options, bets on increases. Ratios above 1.15 historically mark extreme fear and often coincide with short-term market bottoms. The spike to 1.18 indicates panic selling rather than orderly profit-taking, consistent with the velocity and magnitude of the decline. The September 1998 long-term capital management crisis provides a precedent for how positive real interest rates and credit spread widening create deleveraging cascades. In summer 1998, real interest rates on Treasury bills rose from negative 0.5%. In early 1998 to positive 2.8% by September as inflation moderated, while the Fed maintained rates at 5.5%. Simultaneously, Russian government default and ruble devaluation caused credit spreads to widen sharply. High-yield corporate bond spreads surged from 280 basis points in June to 620 basis points in September, a 340 basis point widening. LTCM operated with leverage exceeding 25.1, taking positions across global bond markets totaling over $1 trillion in notional exposure. When credit spreads widened and bond prices declined, LTCM faced massive losses and margin calls. The fund was forced to liquidate positions, but the positions were so large that selling created further price declines, worsening losses. Within 6 weeks, LTCM lost $4.6 billion in capital, over 90% of its value. The Federal Reserve organized a $3.6 billion bailout by major banks to prevent LTCM's collapse from triggering broader market chaos. The sequence from LTCM's peak to bailout was rapid, approximately 10 weeks from initial stress to Fed intervention. The S&P 500 declined 19.3% peak to trough during this period, with most of the decline compressed into 20 trading days in August and September 1998. The velocity of decline, nearly 1% per day, matched the current 30-day period. The Fed responded by cutting rates 3 times in rapid succession, reducing the federal funds rate from 5.5% to 4.75% by November 1998. The critical lesson from 1998 was that positive real rates combined with credit stress creates deleveraging dynamics that can overwhelm markets quickly. LTCM was considered sophisticated, well-capitalized, and systemically important. Yet it nearly collapsed within weeks once real rates rose and spreads widened beyond its risk models. Current leverage across hedge funds, proprietary trading, and private equity may be lower than LTCM's extreme ratios, but aggregate leverage across the system is far higher. creating potential for similar dynamics at larger scale. The December 2018 tightening crisis provides a more recent precedent. The Federal Reserve was raising rates and implementing quantitative tightening, allowing bonds to mature without replacement, shrinking the balance sheet. By December 2018, the federal funds rate reached 2.5%, while inflation was 1.9%, creating a real rate of 0.6%, positive but modest. Corporate credit spreads widened from 190 basis points in September to 260 basis points in December, a 70 basis point widening. The S&P 500 declined 19.8% peak to trough from September through December 24, 2018, just missing the 20% threshold defining a bear market. The decline was concentrated in December, with the index falling 9.2% in that month alone. Volume surged, volatility spiked, and credit markets showed stress through widening spreads and reduced issuance. Margin debt declined $49 billion in the quarter as deleveraging accelerated. The Fed reversed course in January 2019, signaling an end to rate hikes and later announcing an end to quantitative tightening. Markets recovered sharply. The S&P 500 gained 13.1% in January 2019 alone, the best monthly performance since 2009. The policy reversal demonstrated the Fed's sensitivity to market stress and willingness to prioritize financial stability over inflation control or balance sheet normalization. The current situation combines elements from both precedents. Like 1998, real rates have turned positive, currently 1.0% versus 2.8% in 1998. Credit spreads are widening, 113 basis points for high yield in 30 days versus 340 basis points in 6 weeks in 1998. Like December 2018, the Fed is maintaining restrictive policy despite market stress. But unlike 2018, when inflation was 1.9% and falling, current inflation is 3.2% and sticky, limiting the Fed's flexibility to ease policy in response to market stress. Both precedents resolved through Fed intervention, rate cuts in 1998, policy reversal in 2019. But both interventions occurred when inflation was at or below the Fed's 2% target, allowing aggressive easing without inflation risk. Current inflation at 3.2% constrains the Fed's options, potentially forcing policymakers to choose between market stability and inflation control. The mainstream narrative focuses on the 8.4% S&P 500 decline as a normal correction after an extended rally. This framing misses the critical dynamic. The decline is not profit-taking within risk markets, but capital flight from risk assets into cash equivalents, indicating a fundamental shift in the risk-reward calculation driven by positive real interest rates. The mathematical reality that cash now provides positive real returns for the first time in years is being systematically ignored in market commentary. Financial media discusses the equity decline in terms of technical levels, oversold conditions, and buying opportunities. But almost no mainstream analysis acknowledges that Treasury bills yielding 4.2% with inflation at 3.2% provide 1.0% real returns with zero volatility, zero credit risk, and full liquidity. This makes cash competitive with or superior to risk assets for the first time since 2019. The incentive structure explains the avoidance. Financial institutions generate revenue from assets under management in stocks, bonds, and alternatives, not from clients holding cash. A client with $1 million in an equity mutual fund generates approximately $10,000 annually in management fees. The same client holding $1 million in Treasury bills generates zero fees. The industry has structural incentive to frame cash as sitting on the sidelines or missing out, rather than acknowledging cash can be the optimal allocation when offering positive real returns. Wealth management narrative is built around the concept that clients must be invested in risk assets to achieve goals. The standard advice is that stocks return 10% annually long-term, bonds return 5%, and cash returns 2%. Therefore, portfolios should overweight stocks and minimize cash. But this framework assumes cash yields near zero in real terms. When cash yields 1% real return, the risk-reward calculation changes fundamentally. Clients willing to accept 5% nominal returns can achieve better risk-adjusted outcomes in cash than in stocks requiring 11% expected returns to justify equity risk. The second-order effect being missed is the impact on corporate funding. The $2.3 trillion that exited risk markets included $180 billion from corporate bond markets. This capital was financing corporate operations, expansions, acquisitions, and refinancing maturing debt. When this capital withdraws, corporations must either fund activities from operating cash flow, reduce activities, or pay significantly higher yields to attract replacement capital. The result is either reduced corporate investments slowing economic growth or higher corporate borrowing costs reducing profitability. Current corporate debt maturity schedules show approximately $900 billion in corporate bonds maturing in 2026 requiring refinancing. If credit spreads remain at current elevated levels, 156 basis points for investment grade, 428 basis points for high yield, corporations will face refinancing costs substantially higher than original issuance costs. Many bonds maturing in 2026 were issued in 2021 when investment-grade spreads were 80 basis points and high-yield spreads were 280 basis points. The spread widening of 76 basis points for investment-grade and 148 basis points for high-yield translates to billions in additional annual interest expense. The wealth effect mechanism linking asset prices to consumer spending is being underestimated. The $1.4 trillion decline in U.S. equity values represents approximately 5% of total household financial assets. Economic research suggests the marginal propensity to consume from wealth changes is approximately 3 to 5 cents per dollar. A $1.4 trillion wealth decline therefore reduces annual consumer spending by 42 to 70 billion, approximately 0.15 to 0.25% of GDP. This may seem modest, but consumer spending represents 70% of GDP, making even small percentage changes significant for growth. The political economy incentive also drives narrative management. Acknowledging that positive real rates are fundamentally repricing all risk assets would require admitting that the decade-plus zero-rate policy created asset price inflation disconnected from fundamentals. Asset owners, homeowners, stockholders, real estate investors are also voters. Political and policy messaging therefore frames any asset price declines as temporary volatility rather than structural repricing toward realistic valuations given positive real rates. Finally, the mainstream analysis misses the reflexivity, the idea that market prices feed back into economic reality. Declining stock prices reduce wealth, reducing consumption, slowing economic growth, reducing corporate earnings, justifying lower stock prices. Widening credit spreads increase corporate borrowing costs, reducing investment and hiring, slowing growth, increasing default risk, justifying wider spreads. The system can stabilize in a negative equilibrium where declining asset prices and tightening credit become self-reinforcing absent policy intervention, or external shock changing the trajectory. The signal warns that the era of zero real interest rates and forced allocation to risk assets has ended. Markets functioned for over a decade with cash yielding negative real returns, creating structural incentive for capital to flow into any asset offering positive returns. This regime funneled trillions into stocks, corporate bonds, real estate, and alternatives regardless of valuation or fundamental quality. The system was built to operate with negative real rates. Corporate strategies, portfolio construction, leverage ratios, and asset allocations all assumed continuation. Positive real rates break the system by creating competition for capital. When cash provides 1% real return, it competes directly with risk assets, forcing them to offer commensurately higher returns through lower prices. The adjustment process is not smooth because leverage amplifies price declines, creating deleveraging spirals. Additionally, the scale of capital that must reprice is unprecedented. Global equity markets exceed $100 trillion, bond markets exceed $130 trillion, and real estate exceeds $280 trillion. Even modest repricing to reflect positive real rates requires trillions in price adjustments. The specific warning is that liquidity provision becomes more difficult and expensive during repricing. In normal markets, buyers and sellers transact at narrow spreads with ample market makers providing liquidity. During stress, bid-ask spreads widen, transaction costs increase, and large positions become difficult to exit without moving prices significantly. The 38% increase in equity trading volume during the 30-day decline indicates elevated transaction costs and reduced liquidity. Participants had to sell larger volumes to achieve desired position reductions. Credit markets show more severe liquidity deterioration through issuance collapse. Investment-grade issuance falling 42% and high-yield issuance falling 57% month over month indicates primary markets are approaching dysfunction. Companies needing to refinance maturing debt or finance operations cannot access capital at acceptable costs, forcing them to delay activity or accept punitive terms. This transmission mechanism from market stress to real economy slowdown is the channel through which financial instability creates recession. The broader implication is that the Federal Reserve faces an impossible policy dilemma. Inflation at 3.2%, 60% above the 2% target, argues for maintaining restrictive policy until inflation fully normalizes. But maintaining high rates with positive real yields creates ongoing repricing pressure on risk assets, threatening financial stability and economic growth through wealth effects and credit tightening. The Fed cannot simultaneously control inflation and support asset prices when inflation requires high rates and asset prices require low rates. History suggests the Fed will prioritize financial stability over inflation control if forced to choose. The 1998 rate cuts despite no recession, and the 2019 policy reversal during minor market stress demonstrate this preference. But current inflation at 3.2% is meaningfully above prior interventions that occurred with inflation at 1.5 to 2%. Cutting rates prematurely risks re-accelerating inflation, forcing even more aggressive tightening later. The policy space for managing both mandates simultaneously has narrowed to near zero, suggesting eventual policy error in one direction or the other. Between November 12th and December 12th, 2025, $2.3 trillion exited global risk markets. U.S. equities fell $1.4 trillion as corporate bonds declined $180 billion. Money market funds absorbed $340 billion. The flow was not rotation within risk assets, but flight to cash equivalents offering positive real returns for the first time since 2019. The trigger was mathematical. Treasury bills yielding 4.2% with inflation at 3.2% provide 1.0% real return. Stocks trading at 21 times earnings with revenue growth slowing to 3% provide uncertain returns, requiring significant price declines to reach, required 11 to 12% expected returns that justify equity risk over cash. Corporate bonds with spreads widening to 156 basis points for investment grade and 428 basis points for high yield must compete with risk-free alternatives offering comparable yields with no credit risk. The system was built for negative real rates, where cash lost purchasing power and capital had no choice but to flow into risk assets. Positive real rates break this forced allocation mechanism, creating genuine competition where cash can win. The adjustment is not complete. Current stock valuations, credit spreads, and real estate prices still reflect legacy assumptions from the zero-rate era. Repricing to reflect 1% real cash yields requires further declines or a return to negative real rates through policy reversal. The historical precedent suggests this repricing accelerates until policy intervenes or economic weakness validates lower valuations. The 1998 LTCM crisis resolved through rapid Fed easing. The 2018 tightening resolved through policy reversal. Both interventions occurred with inflation below 2%. Current inflation at 3.2% constrains intervention options, potentially extending the repricing period and increasing the magnitude of adjustment required. The $2.3 trillion that exited in 30 days may be early rather than late in the process of repricing global risk assets for an era where cash provides positive real returns and competes on merit rather than by default.